This should be a really interesting conversation. Jon reached out to me and wanted to talk markets, looked into his background, figured it might be, certainly will be a worthwhile conversation. And as always, this will be in all your favorite platforms under that Lead Lag Live banner. With all that said, my name is Michael Guyed, publisher of the Lead Lag Report. Joining me for the hour is Jon Markman, the Prince of Peril, which I think is a good way of describing oneself. Jon, introduce yourself to the audience.
I was supposed to be the Prince of Apparel, but I wasn't dressed well that day, so we just shortened it to Peril.
Right. Okay, there you go. So introduce yourself to the audience here. Jon, who are you? What's your background? You get involved in instant markets, and what are you doing now?
Sure. My name is Jon Markman. I started life as a journalist, worked for the LA Times for about 20 years. I was a financial columnist for a long time. And then when just at the dawn of the internet, around 1997, I got invited by Microsoft to come up and help them start MSN, with the editorial piece of MSN. And so I created with my team the whole everything you see now as MSN Money is stuff that we created back in the mid 90s. While I was there at Microsoft, I got a chance to work with a great team of data analysts and some of the best, including people who literally invented Excel. And I created I used that expertise and some other individuals to create the first stock rating system in the United States since Value Line. And that worked out fantastic, still working to this day. And in around 2002, I left Microsoft, I started a work as a portfolio manager for a hedge fund. That lasted a couple of years. And then I went out on my own as a financial services provider. And that's what I've been doing for the last 15 years. I have four newsletters, I'm sorry. Tactical options for options, precision ETFs for ETFs, strategic advantage about the technology stocks behind the great digital revolution.
It must be interesting kind of being at the early stages of the internet revolution and building out MSN Money. How has financial media content changed in your view from those days in the mid late 90s to today?
It's kind of hilarious because it hasn't changed hardly at all. Back then it was black text on a white background, and guess what? Today it's black text on a white background. Journalism hasn't really, the piece of obviously journalism hasn't changed, and the technology hasn't really changed that much either. We just want to provide information in the most the clear and concise way possible, and it still seems to be black text on a white background. In addition, I think the real changes have been services like this one here at Twitter, with Twitter Spaces, so that people can use their voices rather than typing, which is a big deal.
Do you think that the attention span of audiences has gotten shorter? I mean, back then there was such a thing as a long-term investor, and nowadays I'd argue maybe not so much.
Well, I mean, there's been a lot of studies about that, right? I mean, Fidelity will tell you. People like to talk about the study that Fidelity did. They found out that its best investors over the past 50 years were people who had died.
Yeah, the so-called phantom accounts, right? It's like those accounts that people forgot about end up having the best returns because they're not reacting off of noise and volatility. I think is the point.
That is exactly the point. I mean, obviously, if you can trade extremely quickly like the high frequency boxes do on Wall Street, and you can make money off that, hey, be my guest. But for the most part, I think individuals are best off taking a long-term view.
All right, so let's talk about your long-term view here for a bit in terms of cycles and where we've been. I think a lot of people would be surprised if you entered the year and said we're going to have a regional banking crisis, that you'd have the S&P still up 7% for the quarter. People would probably think you'd be crazy. Now, that's more of a short-term, intermediate term, but what's your view on where we are in the cycle? Are the lows in? Are we in a new secular bull? Just kind of riff on that for a bit.
Sure, with a caveat that nobody really knows anything. I'll tell you my point of view anyway. Obviously last year was a terrible year for technology and for small cap stocks. And coming in when the calendar turned to January 1st, everyone expected the same to continue, except of course it was the opposite. The technology stocks within the S&P 500 are up 21% in the first quarter. And do you know how much the Dow is up? Not even 1%. So it's really been a gigantic swing from the least risky instruments that you could own in last year to the most risky instruments you can own this year. But of course, I don't think really the public, even though that's something we can see on the surface, I think that's really that differential, that delta is really being captured mostly by professionals. I think that individual investors have had a hard time making the transition from thinking from the kind of losses that they suffered with technology last year and bringing it over into their approach this year. Which is all to say, I think that technology has a long way to go, not just this year, but probably for the next 9 or 10 years.
So you don't buy the argument that the tech sector is done, that growth is going to be weak relative to value, that we're back to sort of the old playbook, right? If you want to play beta, you play Nasdaq.
Well, that was last year, right? Last year was all about playing it safe, staying out of the way, and adjusting to the fact that the Federal Reserve was going to raise interest rates by as much as 3 or 4 percentage points. But that was last year. The market looks forward, and so what the question is, what happens next? And I think that investors are looking forward to the end of a rate tightening cycle. Obviously, something that's up for a lot of debate, but I think that's what investors are looking at now, and getting ready for Q2, 3, and 4 that could surprise significantly on the upside.
I've been on the melt up kick really since October, and I keep referencing this point that this is a pre-election year. Pre-election years tend to be the strongest in the presidential cycle, and that this year could surprise a lot of bulls, but it could be still a volatile period. I mean, I happen to think there might be risk of a correction in April, just as everybody's getting comfortable with what seems to be the end of this, in quotes, crisis. Talk about how you think about volatility.
April is, typically the best month of the entire year, in addition to December. And I don't think that's really likely to change too much. I mean, people are really believing the idea that earnings are going to be terrible, the economy is going to be terrible, banks are blowing up, and that if people are settling in, even professionals are settling in for a weak quarter to come. But I just think that's just wrong. The market looks forward. It looks around the corner, and it sees the potential for the Fed to start dropping rates as soon as the midsummer. And if that happens, I think you're going to smoke a lot of bears and quasi bears out of hiding and force them into the market. It's going to be a forced trade. The reality is that professional investors do not lag the market. It's death. Their assets will move, so they're going to have to catch up. And I think that could make a spectacular April and May.
Has it been surprising to you that maybe markets haven't gone down more? I mean, it was on a real return basis, obviously very ugly last year, but the narrative seems to make it seem by the bears, the real bears, that we're in this high inflation environment, it's stagflation, it's going to be years of frustrating movements, and that ultimately we're going to be hitting lower lows. Where are they getting it wrong? I hear you on the point that markets are forward looking, but why is there a disconnect between the narrative that's out there in the popular media and price?
People are naturally scared, and they're just always scared about losing their money in the markets. But the markets survive. They're very resilient. They're made up of people who are greedy. And I'm not saying that greed is good. Greed is good. I'm not going to go Gordon Gekko on you. But the fact that is that it's still the best way for individuals, institutions, and families to grow their wealth over time, and it's going to continue to be that way. I find the timing of the recent rally really interesting. If the current rally turns out to be the rally, its closest resemblances are all occurred in March. Marches over the last 20 years. March 2003 was the end of the bear market. The dot-com bear market. March 2009 was the end of the financial crisis bear market. March 2020 was the bottom of the pandemic bear market. And now, guess what? It's March 2023. Here we go again.
Yeah, I've seen similar points on that. And
you're saying I'm not original?
No.
I'll just throw in one little bone for myself. I did happen to call the October 13th low to the day. It was kind of I did it because I always tell my subscribers that the single best day to invest in the market over time has been October 13th. I mean, if you take all the years going back to 1868 to the present, average them all out, October 13th is the best day. And that actually happened to be the bottom of the recent bear market.
Let's tease that out a little bit. So some people will be skeptical around that idea that there's sort of a regularity in cycles or certain calendar dates, seasonality. What do you find drives those types of dynamics? It seems awfully coincidental.
We're human. I'm not a massive cycle guy, but the cycles rule our lives. We have the tide going in and out. We have seasons. We have the moon going around the sun and the earth. We have as human beings, we're connected to the cycles of the earth. And I think that these, in some ways, I don't mean to be all mystical on you or anything, but I think that it's subsumed into our thinking. And we find that these kinds of cycles happen over and over again. In some cases, just because they're self-fulfilling, so everybody knows that they're there. I mean professional investors.
Right. So if they all start believing it's going to happen, then it happens because they're allocating capital for it to happen. I mean, that's kind of the idea.
It happens because it happens. Yeah, that's pretty sophisticated thinking, but that's where I'm going.
Exactly. Okay. So I looked up on Amazon your book, Fast Forward Investing, which it looks like it came out in 2018. Sounds like you were ahead of that era that we hit in 2020 before a lot of other people were. First of all, I'm just curious, why the interest in the tech AI side back then, gene editing, robotics, all the stuff that we hear now? What turned you on to that as something that you thought back then would be worth focusing on?
Well, I mean, it occurred to me when I started to look at artificial intelligence models that are being used, both for investing and in the real world. I began to get real interested in it, and the deeper I went into the studies of in artificial intelligence and its potential for human behavior, the more interested, the more fascinated I got, and the more interested I was in finding ways to take advantage of it. And to me, you can wrap up the whole concept, the single phrase, the great digital transformation. I think the great digital transformation will be the most important investment opportunity of our lifetimes. And it started back in when IBM created the PC, and it continues now with OpenAI developing the most incredible consumer-facing AI engine we've ever seen. My last book also contained a lot about electric cars, gene editing, etc. These are advances on the very front edge of where we're going as humans, and I think it's important for individuals to be able to learn about those opportunities and invest in them for the long term. And sometimes for the long term can be really short. I mean, sometimes these companies go belly up, but I think if you have a good solid set of them, maybe 5 to 10 of them in your portfolio, you can do really well. And I'm not talking about any crazy little IPOs. I'm saying Microsoft, for instance, has made a tremendous investment in AI. Broadcom has made a tremendous investment. NVIDIA is probably is not just the king of all semiconductors, but the king of artificial intelligence as well. Schlumberger has used artificial intelligence to help oil companies find new sources of energy underneath the ground. So, and Home Depot and all the retailers are also using artificial intelligence to do a better job of matching their inventory with purchases. Just to name one thing. So it's all encompassing. I think that I was fortunate to be able to write the book back in 18, and it's very gratifying to see some of those predictions come true now.
So of the main categories, AI, driverless cars, gene editing, robotics, and the other technologies you focus on, are there anything that you wrote about back then that have maybe played out in a different way than you thought it would? Are there any things that have
I think that artificial intelligence and the great transformation are similar to the advent of electricity that we saw back in the harnessing of electricity, which we really saw back in the late 1800s. And I think the mainstream auto companies are going faster into electric vehicles than I expected. And I would say that on the other side, I thought that by now we'd have a lot of autonomous self-driving cars on the road. I thought that was going to happen by 2020, and I was wrong. It's not. Here we are in 2023, and it's still lagging. But I do think that's a solvable problem, and we'll look back on this and say, "Wow, I can't believe people used to drive their own cars. That's so stupid." I mean, it's quite. Every time that there's an accident with a Tesla, for instance, people say, "Well, there goes that idea. That's never going to work." Well, forget. If you look back in 10 years from now, you're going to see that there were certainly some bumps in the road, but autonomous driving and electric vehicles are trends that are here to stay. They just have to. AI is much better at understanding the road than humans are. Humans are very. We all like to think we're the best drivers in the world, but we're not. And I think that the government and industry are going to combine to say. I think it'll become very difficult to get insurance if you want to be a solo driver. the insurance companies will require you to have a self-driving car.
That's where things are lagging the most, right? I mean, the government is notoriously slow anyway at things, right? Just given it the bureaucracy elements of the way things work. But technology moves at a much faster pace. So I hear you. At some point, it'll be more expensive to insure an individual than a self-driving car, but it was presumably going to take a long time to get the government kind of to be on that bandwagon.
I think that's right. But they're on the bandwagon now. They're looking. They're trying to formulate ways to regulate self-driving cars, and ultimately they'll do it. They'll get it right. I mean, you can just think of all the people back in 1905 who said, a Ford will never replace my horse. Well, there's still horses, but I think Ford won.
When you think about technology kind of reshaping our future and making society wealthier, talk about maybe some of the downside risks and some of the maybe ethical challenges that come about. I mean, the idea of gene editing, right, it can be obviously quite controversial, right? You're taking things out of, in quotes, God's hands, and you're letting science do some of that stuff. Do you think there's going to be some kind of pushback on some of these things, which they're unstoppable, but could be slowed down by certain viewpoints?
Well, there's no. I agree with Elon Musk that we are taking artificial intelligence much too loosely, and I do think that there's a danger of AIs, becoming more intelligent, more capable of doing human-like things, and there's a potential for them to take out companies to drop a lot of jobs. I mean, millions of jobs away from individuals. And so I would really worry about that the most of all the things I wrote about. The AIs can become autonomous, and they can lead us in directions that we can't even fathom today. I'm a little bit worried about it, and I think that it was just a letter signed by like 1,000 scientists who said the same thing. Did you hear about that? It was I think it was earlier this week.
Yeah, and again, I go back to the regulation around it. If any, is not going to be fast enough to catch up. So to the extent that they, the issue that I always have with the AI is it's self-learning, but there's always an element of could there be manipulation of the answers, right, based on
the question to me is could they be sentient? There was a great show on a few years ago. It was created by the BBC based on a Swedish series. It was called Humans. It was on AMC, and I think you can still see it now on Amazon Prime. Tremendous show. I didn't get the viewership that it deserved, but it really looked into this question of how close will we be to our robots, to our what they call them synths, synthetics. How close will we get to our robots? So let's say that will they, if they seem real, but they require electricity to move, can robots have life? Can the robots have rights? For instance, if I shoot my gun at my house, no one's going to look twice. They may think I'm an idiot, but they won't try to sue me. If I shoot a dog, that's a terrible thing that I might go to jail, but it's not a capital crime. What if I want to shoot my robot, who's been my caretaker for the last 10 years? Is that will that be a capital crime? Maybe. So I think these are the things we're going to have to start thinking about. And I think the government isn't even close to thinking about regulating stuff like that.
It may not be a crime, but it's going to be an expense. I think is the way to frame it. I mean, the idea of taking out technology like that.
Exactly. I don't think you're going to go shooting your robot anytime soon. But the question is it sentient? And if it's sentient, does it have rights? And I think that ultimately, in maybe 20 years, we're going to say, yeah, they are sentient. They are sentient in some fashion. They probably do have rights. I mean, I don't mean to sound like a crackpot. I'm just trying to say what might happen in 15 to 20 years.
I wonder if you think on the AI side, it will diminish our collective sense of what it means to be creative. I mean, I'm sure you've seen the same videos I have that people are going to Chat GPT. They're saying, come up with a script relating to some subject. They find somebody on Fiverr to create a video around that. They do some text to speech. And now there's a video that was created with artificial intelligence content.
I love that. I mean, you should try. If people out there who are listening haven't tried it, they should just go try it. You can go to GPT 3 or 4 and type in something like, write me a song about two people who were once friends and are now drifting apart, who go to the ocean and regain their friendship. And then GPT thinks about that for a few minutes, and it'll spit back a remarkably beautiful song using those inputs. So, yeah, I think we're not prepared for the creativity that AI is going to provide to us in positive and some negative ways in the future.
Well, but that's my point. Is that negative point, right? Creativity it's like a muscle. If you're not using it as a human being, and you're having something else be the creative engine, well, then you lose that edge as to what it means to be human, right? To have that creativity, I would argue.
Yeah, I mean, by the same token, I think we've lost the ability to ride horses, as major transportation, but I don't think it's really ruined our lives. I do think that there is some trouble, some worry. It's legitimate to worry about the loss of creativity in the rise of AIs. But I think that other types of entertainment and creativity will replace the ones that we're familiar with. Who could have imagined, 1920 that we'd be sitting around watching, cable television, streaming TV, streaming shows and whatnot. But it didn't really ruin our creativity. It's just enhanced our lives in a new way. You know what I mean?
Yeah, no, that's fair. It's just I'm cynical of the way, and maybe this is me being the old man yelling at the clouds, that kind of meme, but it's like younger generations seemingly, from my perspective, are getting lazier because it's so much easier to be lazier because they can simply put something in ChatGPT and then get their homework questions answered without even thinking.
Yeah, well, yes, that's probably true. And if that person doesn't get a good grade in school and falls by the wayside and doesn't go to college and ends in a menial job, that's sort of the universe's way of taking care of that, of people who are using the technology in the wrong way. But I think that there are lots of positive ways of thinking about GPT. It really, for people like journalists, it provides a level of research that it could have required like 7 hours worth of effort, and you condense it into 10 minutes. And what are you going to do with those other 6 hours and 50 minutes? Probably, yeah, you can find a lot of good uses for that. Maybe go to the driving range and improve your golf stroke. Not that I'm speaking personally or anything.
But exactly. Let's relate that again to the point about the Nasdaq and kind of big tech and kind of a broader cycle that continues for big tech as the leader. One of the frustrations, criticisms, whatever you want to call it, of the last decade is you ended up having this real concentration around just a few mega cap tech companies that really drove the headline averages, while most other things really didn't. Even this quarter's performance would not anywhere near look as strong if you took out Microsoft and a couple other big cap tech names. Do you think that AI will only further the market cap concentration of these big cap tech names because they're the ones with the resources to create it, to implement it, and then capture all the alpha out of it?
I don't really worry about that, to tell you the truth. Yes, they will use it in important ways, in valuable ways, but I think that AI actually will help. The ChatGPT and the rest will help smaller companies become larger, more efficiently, because they won't have to pay a lot of people who are making high salaries and whatnot to do the work that can be now seen as a little bit more menial. So, yeah, I'm not that worried about that. Are you?
Well, I worry about it from the standpoint of just concentration risk, right? Just if you think about just a passive benchmark, right?
The thing I do worry about the most, though, is I think about my kids. When they were in junior high school, every night they would have book reports and speeches and things to work on, and they would do their work, and then they would bring it to me, and I would go over and tell them about how to do a better job of using commas and paragraphs and phrases, and teaching them about parsing language and stuff like that. And they both grew up to be pretty good writers and thinkers. I worry about the fact that a kid can go to ChatGPT and ask for a book report on, One Flew Over the Cuckoo's Nest, and get it in 30 seconds, and rather than thinking about it themselves. And so far, we haven't found any ways of preventing them from doing that. So I think that's just, I don't think it's a bad thing necessarily. Well, it is a bad thing, but it'll be interesting to see how schools and municipalities regulate the use of these tools by students.
Right. Basically, you need AI to tell if it's AI. Right. Right. I think it's kind of which is actually a whole nother bizarre derivation.
That's a good one.
No, but really, I don't like. How else would you do it, right? If you're going to, you need to have something that could tell it's a marker or something that's artificially driven.
As they say in basketball, game recognizes game.
Right, exactly right. I mean, that's kind of the idea there. I got a question from one of the audience members saying, "Can you ask Jon about the Tesla robot, his opinion and on that and Neuralink?"
You want to know about my opinion about the robots being used at Tesla? I don't know much about them today, to tell you the truth. All I know is that robots in the factory floor have proven to be not as effective as early advocates wanted them to be. And I think that they'll get a lot better as time goes on. But right now, I think that they're, you look at what Elon Musk has achieved and you have to tip your hat to him. But the robots have not proven to be as effective as I think even his team expected. And so there's a lot of growth available in that space. And what's interesting is if you look at the stock market, I would have thought that there would be a lot of great companies to invest in to take advantage of robots, but there really aren't. All the robot-focused companies have been pretty weak. I think it's because maybe they depress margins, or they just aren't as effective as we all thought they would be in the beginning. And there's a lot of things that aren't. There's a lot of things that aren't as investable as you might think. Like for every house, every car needs airbags, for instance. But you're not going to go out and invest in airbag companies.
Yeah, and I think that's actually maybe a good direction to go, which is, if you're trying to play some of these mega tech themes, are there more levered ways of playing them, more direct ways of playing them than just the Microsofts of the world, right? And if there are, how do you even go about identifying them?
I would say there are lots of smaller companies out there who are doing interesting things in that space, but I don't really think that the Microsofts, Nvidias, and monolithic power. I think these chip companies are not that expensive right now, particularly after the recent 2-year shakeout. And it doesn't bother. Their valuations are high, but they're not nothing like outrageous. Nothing like the kind of thing we saw before the big financial crisis, or certainly not as high as during the mid '90s or the .com era. Are they more expensive? Yes, they are more expensive because they're growing faster.
Going back to the your prior life on the journalism side, was there more of an edge in following news flow back then when it came to figuring out future investments than there is today? I'm curious if you think markets are maybe more efficient or even less efficient in terms of the reaction to news flow.
Well, I think it's much more efficient today when information gets disseminated via Meta, via Facebook, via Twitter, via Instant Messenger, etc. Yeah, I think that's the case. What do you think?
It's hard. In theory, yes, you're right. It's more efficient, but there's also more. I would say overpricing, right? So just like this regional bank crisis in quotes, right? Everyone saw the headlines. It was priced in pretty quickly, but then it caused an overreaction in terms of this narrative that it was the end of the world, which caused right. This, you can argue a bit of this rip, right? This month.
The reaction function was amazing. We're going to be studying what happened into Silicon Valley Bank for decades. That will be a case study of the psychology of banks. And I think really one thing it really did is exposed what banks really are, which is just a giant box of leverage.
That sounds like the whole U.S. economy. In fairness,
well, you look at them, and what you see when you see a bank is you have this thin layer of deposits at the bottom of it. All right, and let's just say you have a 20 brick stucco wall or brick wall. You have the bottom 2 layers of rock are your deposits. Then you have like 18 rows of leverage, like of credit, and those deposits are holding up all that leverage. But if you have something come along that takes out that layer at the bottom, the whole thing falls down. And that's what we witnessed 2 weeks ago. We got schooled on the concept that banks are very dangerous leverage boxes of high leverage, and they should be treated with a lot more caution than they are.
And that basically killed the whole value. I mean, to your point about the reaction function, it's also the reaction function internally by the market. The response to the banking in quotes crisis wasn't get out of stocks; it was rotate out of financials, but stay in stocks, and which is what benefited tech.
Right. I think it's fair to say that tech picked up the balance. Some technology companies picked up the psychological edge in the investors' minds, and I think you've seen the phrase that's very popular right now. The one thing that's very popular to say right now in investment circles is that big tech is a safe haven, which is kind of hilarious. But it isn't actually that crazy because, you know, you could easily one day wake up in the morning and discover that your shares of a bank have gone to zero. But that's never going to happen with the Microsoft or Nvidia. You're not going to wake up one morning and find out your investment went to zero.
Yeah, I mean, listen, they're safe havens until they're not. I mean, this is like classic narrative following price. I mean, if you have a real credit event or something that just shakes beta, to think that any sector would be held higher, yeah, you're gonna have relative outperformance, sure, but real fear does not discriminate around whether it's AI or an energy stock. What any interesting observations that you've been kind of noting in some of your research that are maybe emerging trends or themes that maybe people are not focusing on?
Well, I mean, you don't really need a lot of themes to power a market, and right now I think the emotional edge has been the exit of the re-entrance of people into technology stocks after having abandoned them last year. If you had a year's worth of abandonment of technology, and now it's only been three months that they've come back into favor. They have a long way to go, in my opinion. You've probably seen this in your own work, Michael. There's no great. I mean, obviously people get excited about stocks and they become great bulls. But when people get down on a stock and they're bearish on it, it takes them even longer to give up a bearish position. Then it takes them to give up a bullish position. And so that makes these kinds of periods really drag out. The last major crisis that we had that ended in March 2009, nobody wanted to touch stocks. Nobody wanted to touch technology. Nobody wanted to touch risk. And yet, at the bottom, as I said earlier, stocks are the best way for families to build wealth, and they came back but it took 10 years. I think that the crisis this time lasted about a year. So maybe this cycle lasts 6 or 7 years this for tech instead of 10.
Yeah, that point's an interesting one, right? The idea that people get more invested in a bearish thesis than a bullish thesis. This is probably where it's true. I mean, you always sound smarter being negative, right? I mean, as a generalist, right? It's just the negative narrative always sounds smarter, but that's also probably why the momentum phenomenon exists to begin with. Why there's underreaction and uptrends, because it takes time for that negative narrative to become a positive one, and oftentimes by the time everyone's suddenly positive, it's the end of it.
I think it's right. And this is why you look back and you just try to put yourself back in the shoes of where you were on March 6, 2009. I mean, people had gone way past the apathy stage to almost hating stocks. Yet that was the beginning of a 12-year bull market. And we've gone through a period now where the stocks were hated for about a year and a quarter, I would say. So maybe we have another 6 to 8 years to go to get people back involved.
Do you get a sense that people hate stocks more or hate bonds more?
Good question. What do you think?
I always have a problem with the idea that it's the end of the, in quotes, 40-year bond bull market. I know everyone uses that line. The problem that I have with that is it assumes that you're at the end of the government spending bull market. You can't have an end to a bond bull market unless you end government spending, because the rates have to be low in order to finance that government spending, right? Which means higher bond prices, lower yields. So and I'll tell you just for anecdote. I mean, I think a lot of people. First of all, I think a lot of people don't really understand bonds in general, right? People are used to just thinking about volatility in stocks, not volatility in bonds. Volatility often brings opportunity after extreme volatility. You had the most volatility you can imagine in the bond market last year, but nobody wants to still touch them. Even the narrative that you keep seeing about, why would anybody invest in stocks when you can get, guaranteed 4%? It's like, is anybody really pulling out of their stock portfolio to go into T-bills? I don't see it.
Well, people forget. I mean, I was around during the 1980s, around on money market funds when the inflation was way up. I remember back in the 80s when there was high inflation and money market funds were going for 10%, 11%, 12%, 13%, 15%. And I remember my mom being so excited that she could get 15% of her money. So she would move it from bank to bank as different banks offered higher priced CDs. But what she didn't really understand, and which I tried to explain to her over and over again, is that you only get a 15% money market fund if your inflation's at 16%. there's no free lunch. You don't get 5%. And right now, you don't get 5% on a CD for nothing. You get 5% because inflation's at 6. Basically,
Right.
The real value of buying one of those CDs or money market funds is much lower than advertised.
Yeah, no, and people always think in terms of nominal, not real. I mean, that's just the real. Which and maybe that's your argument. It's like at least with stocks, you might have a chance at getting some positive real return, which is why nobody wants to go into T-bills because no matter what, it's still negative real rates.
Yeah, well, inflation erodes the value of money, and it makes money today worth less than money tomorrow. So it's really a nasty cycle, and I just think that for the most part, people at the end of their investing, of the periods in which they need direct access to their money, and should move into some kind of credit instruments that are safe and advised by as advised by their financial manager. But during their working lives, I think people should. The evidence, the research shows that stocks are a much better way to build wealth over time.
Although it's important to note that research is only showing that in U.S. markets because the reality is international is still a basket case. I mean, I think that's kind of a frustrating part of wanting to diversify globally. It's hard to justify it when the U.S. is the only game in town.
Well, I mean, that's not strictly true. I mean, Asia, has been a mess, but Europe is out performing the United States by a mile this year, and in fact, especially Spanish banks in particular have done extremely well versus U.S. banks. I'm talking about banks like, the usual suspects in Spain, BBVA and Banco San. I'm blanking right now. It's symbol SAN. But yeah, if you look at Europe right now, it's actually doing quite well. And just despite the war in Ukraine, yeah, they over a 10-year period, you'll only see Europe typically surpass U.S. stocks in a calendar year about twice during a 10-year period. And I think we're in one of those right now. If you wanted to, drop your J.P. Morgan and buy something like BBVA or SAN, I think you'd probably be happy by the end of the year. Also, the European steel stocks are doing extremely well. Europe is in a pretty interesting space right now. They're exiting a period of skepticism and loathing, and their populations are increasing, and their demand for things like steel and construction equipment and lawns is increasing. So if you want to look overseas, I think that's the place to look. It's also fun to go visit your money in Spain.
Listen, I have not been to Spain in 2 decades, but I remember Madrid was one of the cleanest cities you could possibly ever visit. You don't see much of that in New York and San Francisco, for sure, compared to Spain.
There you go. We have a cleaner investment environment.
Yeah, no, exactly. How do people find you, John? For those that might be interested in some of your work, some of your research,
they can text the word FAST, FAST, to 206-672-5064. And if they do that, they can get a free digital copy of my last book.
Yeah, and your website?
Markmancapital.net. www.markmancapital.net. We have 4 newsletters that have done extremely well this year, and we would appreciate and I'd love to have an opportunity to discuss that with some of your listeners. Once again, text FAST to 206-672-5064, and we'll email you back a digital copy of my latest book. It's called Fast Forward Investing.
That's a good place to wrap this Twitter space up. Hopefully it was enjoyable. Thank you, John. Appreciate it.